Welcome to the lecture 19 of Financial Risk Management. We are going to continue our discussion on the option strategies. In previous two lectures, we saw the covered call strategy, we discussed protective put strategy, and then we discussed a fiduciary call strategy. And in this lecture, we are going to cover long and short straddle and long and short strangle. And once we have explored these two strategies, we would limit our scope of strategies to all these 5 strategies that we have discussed. And then we will move towards the theory of option pricing. And then we would see if we have additional time on our hand, we would explore some other strategies as well. But for now, we would limit ourselves to these 5 strategies that we have. So long and short straddle and long and short strangle. So first we would start with long straddle, or straddle for simple. So what is long straddle? By the way, what is straddle? When we take both call and put option. When we take position in both long and when we take position in call and put option simultaneously, then that is called straddle. But it would be a long straddle when we have a long position in call option, so long call, and we have a long position in put option, so long put. For a specific stock, the call and put have the same expiration date and the strike price. So one thing that makes straddle and strangle different is the strike price. So when the strike price of call option and put option is same, then we would have a straddle, and when the strike price of call and put option is different, then we would have in strangle. But anyhow, that we will discuss later on. So long straddle is when we have a both long call and long put position. And why would we have this kind of a strategy? Because when we have this strategy, we know that we earn profit when from long call when the price increases. We earn profit from long put when the price decreases, and when we combine these two strategies, although their cost is high because we have 2 premiums, but excluding those 2 premiums, whether the price increases or the price decreases, this strategy, the combination of this strategy would always give us some profit, right? So long call and long put, if the price increases, long call would give us profit. This would give us the loss, but the loss would be lesser than compared to the profit. If the price decreases, this part of the strategy would give us profit. This would give us loss, but again loss would be lesser than the profit. So when we enter into a long straddle, when we want to gain if the stock moves substantially in either direction. So in case of long straddle, we earn irrespective in which direction the price moves. The direction is it doesn't matter, the direction doesn't matter, but what matters is that the move should be substantial, that the increase or decrease should be substantial. The substantial is needed because to absorb the cost of the premiums. So we don't gain from this strategy if ST is closer to the strike price. So the increase or decrease should be substantially higher. So have an example. The call option premium is $10 per unit. Put option premium is again $10 per unit. The strike price is 110. The strike price is same for both for the call and the put. You need to calculate the profit and loss when the price is, future spot price is 80, 90, 100, 110, 120 and 130. The break even, in this case, in case of straddle and strangle, we would have 2 different break evens. One break even would be strike price plus both the premiums, and this would be called the upper break even point. The second break-even would be strike price minus both premiums, and this would be called lower break-even point. And our maximum profit would be unlimited. Our maximum loss would be limited to both the premiums. Now this strategy would be clear from this graph. You see, this is our maximum loss. This is the loss of both the premiums. So in previous case, we had a premium call premium of $10 and a put premium of $10. So our maximum loss from previous case, from previous example would be $20. Again, we would have two break-even. This would be our upper break-even, where the profit or loss would become 0, and this would be lower break-even. So we would have two different prices. In previous strategies, we only had a single price. When the future spot price reached to that specific price, then we would have a 0 profit loss. But in case of Straddle and Strangle, we would have two different break-evens. So either the future spot price becomes at this level or at this level. In both cases, we would have a 0 profit, 0 loss. And as the price increases, we would have, or decreases, we would have profit. So you can see that whether the price increase or the price decreases substantially, in either direction, we earn profit from this long straddle. Okay, so again we are going to use the manual method to calculate profit and loss of this strategy. The long call, the profit and loss from long call can be calculated using this formula. This isn't a new formula. We have already seen this formula: maximum of 0, ST minus K minus premium, and the long put profit loss can be calculated using this formula. What if the future spot price is 80? 80 minus 110, this would give us 0. So 0 minus, right? So we get the profit of 10, total profit of 10. So you would notice that long call is giving us loss, but long put is giving us profit. So they would always move in negative direction, different direction. What if the future spot price is 90? Our loss from long call, our profit from long call, so this would be 0. When future spot price is 100, we would have loss from this position, and we would have no profit, no loss from this position. So 110 minus 100 would be plus 10, minus 10, 0. Our total profit would, loss would be minus 10. At 110, our loss would be 20. This is our maximum loss, which is both the premiums. So 110, if you remember from the data, 110 was the strike price. So when ST reaches K, then we would have a maximum loss. So this is our maximum loss. So as ST increases to 120, now our long call would start giving us profit and long put would give us loss. Our total loss again is this. But now as it moves substantially away from the K, now in this case 180, so it is substantially away. So this long call would give us a profit of 60, long put would give us maximum loss of minus 10, our profit would be 50. So now you see that when they move in either direction substantially, we get profit. Okay, one thing, how do we calculate the profit loss of long straddle? using a single formula. So in this case, the formula, single formula would be maximum of 0 comma st minus k minus premium plus, and then we would have this whole formula. So it would be maximum of 0 comma k minus st minus premium. So we are combining these two formulas. So just add these two formulas and we get the formula of long straddle. Short straddle is opposite. We take short position in a call option and short position in a put option. So it provides the option writer with income of two separate options. Possibility of substantial loss if the underlying stocks moves substantially away. So it is the opposite of long straddle. In long straddle, we earn higher profit when the price substantially moves away from the strike price. But in case of short straddle, we would have a loss if it moves substantially away from the strike price. This is how the graph would look like. Our maximum profit would be at this point when ST would be equal to K. Remember, in long straddle, our maximum loss was when ST was equal to K. We would have again two break-evens, and our loss would increase when the price would either substantially decrease or substantially increase. Now, the short call formula is minus maximum ST minus K plus premium. This is the formula for short put. When we combine these two formulas, we get the formula for short straddle. What if the price is 80? So now I would just focus on the main idea. You see, then when the price moves away substantially from the strike price is 110 and the future spot price is 180, then we have a higher loss. If it is closer to strike price, we would have a lesser loss, or if even it is equal to strike price, then we would have the maximum profit. One last thing that I forgot to mention was the break-even point. So break-even point would be strike price, right, 110 plus both the premiums, which is 20. So one of our upper break-even point would be 130. If the future spot price becomes 130, we would neither have a profit nor loss. And when this future spot price 110 minus 20 is equal to 90, then we would neither have a profit nor loss. So this would be our upper break-even point, this would be our lower break-even point. And you remember from these calculations that when the future spot price was 90, which is equal to our lower break-even point, then our profit loss was 0. And when the future spot price was equal to 130, which is our upper break-even point, then again our profit and loss was 0. So that makes sense of the formula. Okay, coming back to strangle, this is our last strategy. In strangle, we also have a long strangle and long straddle. The difference between straddle and strangle is that in straddle, we only had one strike price, and that strike price was similar for call option and the put option. But in case of strangle, we would have a different strike price for call option and a different strike price for put option. So in case of long strangle, again I said, as with the straddle, we had long straddle and short straddle. In case of strangle, we also have a long strangle and a short strangle. A long strangle is when we have a long call and long put with different strike price, and short strangle is when we have a short call and short put with different strike price. Let's have an example. Let's say call option premium on stock is $25 and the premium is 20. Premium can be same or can be different, but strike price would be different for both call and the put option. Calculate profit and loss of long strangle if spot price at the time of expiration is 75, 100, 125, 150 or 200. So again we have these two formulas, and when we combine these two formulas, we add these two formulas, we get the formula for the long strangle strategy. Okay, if the spot price is 75, maximum using the long call formula, maximum of 75 minus 105. Now you would notice that in previous cases when we were discussing long straddle, we used the same 110 strike price in both the cases, right? But in case of strangle, we have a different strike price. For call option, the strike price is 105, and for put option, the strike price is 115. So the long call would give us the loss of 25, and the long put would give us profit of 20. We do not need to solve it, and I do not need to go step by step, because we have seen these types of formula in many of our lectures. So our total profit loss would be 5. When the future spot price is 100, our total loss would be 30. Again, as in case of long straddle would always also give us the maximum loss when the future spot price is equal to or near to the strike price. So 100 is nearer to the strike price, so that's why our profit is decreasing or our loss is increasing. So now we have minus 25, and as we substantially move away from our strike price, our profit would increase. So in case of 200, our profit would be 50. Okay, so how do we calculate the break-even point of a strangle? The lower break-even point is the strike price minus both the premium, right? So the strike price of the put option, so the strike price of put option was 115. Both premiums are 20 and 25, so our lower break even is 70, and our upper break even is call option strike price plus both the premiums, it is 150. So when the future spot price is 150 or 70, we would have a zero profit or loss. When it is between 70 and 150, we would have loss, and when it is lower than 70, future spot price is lower than 70, or it is higher than 150, then we would have profit. And lastly, the long strangle contingency graph. Again, we have two break evens, and this is our maximum loss, which is equal to both the premiums. Now, short strangle, we take short position in both call option and put option. Again, we use the short call formula and short put formula. We add them up, and it would give us the formula for short strangle. If the spot price is 75, it would be exactly opposite of long strangle. So the profit of short straddle would be exactly opposite to the profit of long straddle. And as we saw in long strangle, we had a loss of 5 at the future spot price of 75. So the opposite of this minus 5 would be plus 5. So in case of short strangle, we would have a profit of plus 5. So I would recommend that you solve the remaining part of this short strangle and see how does the profit and loss moves, what is the maximum profit or maximum loss. So in future videos, we are done with the strategies option strategies, we are going to develop our theory of option pricing.